name's Don Aguilar. I'm the superintendent. This is Billy Guidry, Chief Financial Officer, Matt Duga, Executive Director, Director of Finance, and Mona Bernard, Director of Insurance. So, election of officers of the Board of Trustees.
That the OPEB Board of Trustees accept the slate of officers for the trust as per the trust document.
Okay. Second. We have a second on that? Okay. All in favor, say aye.
Aye.
Congratulations. Is my name on there? Yep. Okay, item 4, review of OPEB liability calculation and new Gatsby pronouncements, footnote benefits, and actuarial consulting.
What I have here is government agencies who have retiree benefits other than pension, health care, life insurance, are required to calculate the liability once every 2 years and disclose that liability on their financial statements. Lafayette School Board has life and health, retiree life and health plans. The current liability on your June 2016 financial statements will be $391,858,188. The way we calculate that is you give us a census with everyone's name, date of birth, date of hire, coverage, and the cost of that coverage. Based on that, we are able to know when was someone born, when were they hired. Based on those 2 dates, we can expect, based on your retirement system, when they expect to retire, and with mortality, when they expect to term. We do that for everybody, and so there's a stream of payments from when they're 60 years old until they're in their 80s, discounted back to today, using a discount rate. The current discount rate we use is 4%. That delivered that $391 million present value liability. Now that liability is expected to grow every year by 4%. It's not constant because it has a discount rate. So every year is expected to grow 4%. That's the assumption that we use. The actuarial value of the assets, which you can discuss later, is $11,367,332. The unfunded liability is $380 million, so you're only 2.9% funded. Compared to all the other school systems in the state, there's only 3 or 4 that are funding this liability. There's about 10 sheriffs that are funding the liability and a few parishes. So most people have not funded for this. However, these new guidelines that are coming out are going to make it very difficult and costly if you don't fund to certain levels. The current normal cost, well, going back one step above, the current under Gatsby 45, you can amortize this liability over 30 years. And each year, for the last 10 years, you had a net adjustment that you added to the liability. So every year, you've only been booking as a liability in your financial statements a portion of that 391. So far, that annual liability is added up to $254 million. However, next year, that calculation is going away, and you take the full $391 million, and that goes on your financial statements as an obligation. This has 2 components. The normal cost, this next item, is $9.9 million. That $9.9 million is 1 year's liability. Okay? So every active employee you have, at the end of the year, they vest 1 more year of liability towards whatever the liability is for retiree health care. So if you have to work in this retirement system, this system for 20 years, they would vest 1/20th of their future liability each year. So every active person, their cost of promising that benefit 1 more year, they have 15 of their 20 years vested, is worth $9.9 million, or $304 per employee per month. So your health insurance cost is $597 for your PPO. The additional cost for that promise that you're making is $300, to give it a perspective. So if you were going to fund or budget for this, you would take the $597 as cost plus $304, less whatever the employee or the dependents contribute toward the plan. Any questions on the liability?
Since of the liability, so the organizations that have established a trust will have an advantage over those that don't. At this point, with the new Gatsby's, I would think. Would you think that a lot of other districts are going to be following to establish trust?
I think they will. Just because the liability is so much larger in the future if you don't fund for it. If you aren't doing something. I think they're either a fund for the liability or they're going to reduce these benefits or eliminate the benefits. That's my, this liability here, 70% of it comes from your Medicare retirees. Your retirees without Medicare don't generate a lot of liability because they're only on pre-65 for 2 or 3 or 4 years. So if you would not have Medicare retiree health care, like Lafayette government does not, and many of the parishes do not, or cities do not, if you would not have the Medicare portion, your liability would reduce by 70%. Because the Medicare portion, they're on there for 20 years. Someone 65 can live for another 20 years easily. So if you're looking for future ways to reduce this liability, it is addressing the cost of Medicare. And that's either through Medicare D coordination or Medicare Advantage, or I know some sheriff's offices and others, and new employees would not benefit from Medicare retiree health care. You don't want to eliminate retiree health care for those under 65, because that actually is a benefit to governmental agencies, because it's cheaper for someone to retire and you replace that person with a less expensive person than to pay a couple years of retiree health care under 65.
So you're saying requiring maybe new employees sign up pre-agree to have a Medicare supplement at 65 rather than staying with
Anything.
a Medicare supplement that
And the reason why school boards are thinking about this, no one has done this yet, but I have 40 school boards as clients, and they all have the same problem. They have 25% of their workforce can retire in the next 5 years. So you have $391 million of liability. Possibly 500 to 800 employees can retire in the next couple years. They're eligible to. They can retire, and you have to replace those employees, and it's going to be a large replacement. New employees may not have the expectations of retiree health care after age 65 than someone who's currently an active employee who is 50 years old. That's just something to consider. Right now, you have to offer them something.
encourage it, but then at EBR, if you want to stay on the plan, you pay the cost of that.
And so the St. Tammany.
Medicare plan.
Yeah, and that's the same. It doesn't matter to your liability. Your liability is reflective of what the cost is. So your Medicare Advantage is $230-something. Your retiree health cost, I did a calculation of it just to give you an idea of what the real cost is. It's $721 per employee per month.
That's a Medicare eligible?
That's all retirees. They didn't break it out. you're expected to have $17,500,000 in healthcare costs this year. Half of that is prescription drugs. Half. And, you know, the prescription drugs now are very expensive, but they cure you. I mean, with hepatitis and with these prescriptions for diabetes and cancers, they're in the hundreds of thousands of dollars, but you live if it's caught early.
So the Medicare Advantage plan we put them on would actually, the benefits could actually be better, and in our situation, better or richer than the benefits in the plan.
Yeah.
Is there anything from the status of Blue Cross and where they are on
See, what many of my other clients are doing, not school boards. School boards have a tendency not to have the flexibility that smaller employers have, is allowing employees to drop off, sign a contract, a board approval, that they waive coverage and buy one of the free Blue Cross or Humana plans or People's or Aetna's. But if they wanted to, they could come back. So that's something the board could ratify and let people drop off and buy the Blue Cross plan. I'm not sure what the price is for this year. It might be free, it might be $25.
Do that with the
Okay. So that would be something, because they're going to have the free one here. And if someone could educate the retirees on what's the deductible and out-of-pocket of the PPO plan versus the monthly premium or the monthly premium and out-of-pocket, have an exhibit, and then have an exhibit of what's the free out-of-pocket. The Blue Cross plan doesn't cost anything. Medicare, Humana, Medicare. The group one you pay for is because Humana and Blue Cross don't want to write a group policy. They told me this hundreds of times. Because it's expensive for them to file a plan with the state of Louisiana.
So they go individual.
If they go individual, they drop your plan, buy the one that they can look online that's free, and then next year, if they didn't like it, they can come back to the PPO. Those are options to consider.
So if you offer them an incentive.
Well, the incentive has
That's not enough?
But I thought
The
the
incentive-
Humana's
the-
free, they
Yeah,
get
we pay
through
the full
us.
premium.
So we give them a Humana for free.
Right.
We absorb the $270 whatever, because the plan is paying $5 something or $7 something. So every month for the cost, and then if we pay the $2 something to Humana, they cover the cost.
right. But if you wanted to do the Blue Cross could have they could have a pitch to all your employees. It's the individual product that anyone could buy, but you have to have a contract that employee signs that they're leaving because most plans say once you leave you can never come back.
Ours says that, but
You
we
have
could
to
waive
change
it.
that, and then you get out of that business.
So Blue Cross is hesitating on doing a group plan, but they're giving you a free plan.
Use that website I gave you. To Choose My Low. It's a great website for finding every plan.
Tell me how phone this is. It's CHOOSC
MYLO. It's Lockton's. You put in your information and you put in your zip code, and it shows you. You go to the Medicare Advantage or Medicare D or Medicare Supplement. It shows you all the plans that are available.
There's a free Blue Cross line, so I wouldn't wear that.
It's free in Baton Rouge and New Orleans. I think it was $25 in Lafayette.
Paid employee more than the 25 to go on free?
You can give them dental.
Like give them a health bonus or something, something like a wellness bonus. So if they go on the free, pay them $50.
What's probably more appropriate is to get since you're not setting your rates correctly, and you're going to have to start doing that going forward because you have to actually disclose it next year, what your costs are, and they want you to build a 10-year record of your actual cost for retiree benefits. We can talk about what the new requirements are next, but if you put the cost, right now your Medicare PPO is at $337, and the real cost is probably double that. setting your rates too low currently. Yeah.
That's what got Johnny
It's, the cost of retiree health care for Medicare has gotten so expensive because of the prescription drugs.
Yeah.
I mean, it's so expensive. But if you use Medicare D, you'll see on that website how much Medicare D costs. A no deductible retiree prescription drug plan is anywhere from $25 to $70. Because Medicare is supplemented so much. You're not being really supplemented by Medicare. Yeah.
It's not 100%.
It's and they cut that back. How much? What is it? A couple $100,000 now?
Last name was
600.
last year.
Your drug payments for retirees last year are expected to be just drug alone is expected to be half of 17 million.
Yeah.
A Medicare D prescription.
Yeah.
How does it compare to ours in terms of what it's covering?
Well, we have to be comparable to them in order to qualify for the subsidy,
Yeah.
but Scott's probably better
Well,
versed in.
it's better actually. Depends on how much prescription drug you're using. Each one's going to be different. Their plan design is going to be different, but the problem you used to have was they had a donut hole. You got prescriptions at a copay until you got the donut hole. Then you didn't have coverage. Then after the donut hole, it was covered at basically 98% or 96%. Depends on which drugs you're paying. If you're paying high dollar brand name drugs, it very possibly and probable you would be better off with the Medicare D card that you buy, just like you buy Humana Medicare Advantage. And you can, there are so many options available out there without using a broker or anybody, no commissions to anybody, from people with Medicare. Coverages are no cost or very little cost. You're paying you can't take advantage of that because you're buying group policies. Group policies really don't coordinate with Medicare D or Medicare in general when you're buying the self-funded PPO policy. You have to go out and get a Humana Advantage plan like you have, but then that's a custom plan and it's more expensive. If you could look and see what's available to anyone out there, there's so many plans available because Medicare pays so much now.
Scott, originally when we walked in, you mentioned with Pat Lucian and their liability was
$1 billion.
$1 billion, and they cut it.
Half. What they did is they put in Medicare Advantage Humana plan and said if you want, you get that free, retiree. If you want to have the PPO, you have to pay additional $250. It's your choice. And that didn't go over very well, but it saved them $1 billion. The cost of this retiree health care plan, which you're promising, is $9.9 million a month. I mean, a year. And that's what all the governments with these new procedures that are being rolled out, Gatsby 75, is making everybody, or forcing everybody to address these issues next year, following you, because it all goes on your financials as a debt. So it's like floating a bond for $300, $400 million. And if you don't fund for the bond, it's going to be a 20% increase on that amount. That's how the numbers come out.
How hard is it to separate the cost of retiree health care for MEIs versus those who are not yet Medicare eligible?
It's all on how you set it up.
Okay.
I mean, I have not seen your experience broken out. I think I requested a year ago when we took over the group to start breaking out, have Blue Cross set up different group codes for active retirees without Medicare and retirees with Medicare. I'm not sure. I haven't requested the information. We'll request that information in that format when we do the next actuary evaluation.
I think we need that because we're considering sure we're fair about it.
Right. What you're supposed to do is what the state does with all the state groups and all the schools that are in the state. You're not required to implement this yourself, but we're required to track it. Is your active cost tracked for active employees? What's your healthcare cost for active employees? $550, whatever it is. What is your healthcare cost for retirees without Medicare? Probably double what the active employees cost. So it's 60 to 65 without any supplement of Medicare. And then what's your cost for those Medicare eligible? And right now you have a $330-something rate. We know that's probably half of what it should be.
If we do ask them to change it. I just want to make sure it gets done.
I thought it was somebody at Blue Cross.
I sent it to. I can request it again, as long as they can break it out. I have not communicated with Blue Cross.
So somebody here.
Somebody at Lafayette.
Oh, we should.
What you would do is you would have them set up a separate subcode.
Yeah.
But we would have to set, we'd have to request it.
Yes.
I think
I know maybe Cassandra.
It's as long as it's now going forward, it's fine. It's not a,
she doesn't have that authority.
Oh, so
It has to come.
okay, so it didn't get done.
those are just some options to consider.
Well, no, because if you're telling me you didn't do it, I don't think anybody did. That's my point.
The other piece, Gatsby 75, goes into effect for you next June 30, 2017. You're going to have to implement Gatsby 75. It replaces Gatsby 74. It basically says you have to put the full financial impact on your financial statements. And if you're funding, you have to fund to at least an appropriate level to be able to consider funding. If you're funding, you get to take full advantage of the discount rates and all the mechanisms for funding. And you can, depending on your investment policy, you can have a 20-year investment horizon of 7% or 4% or whatever you and tell us what your 20-year horizon is going to look like. If you don't fund, you have to use a 20-year mutual bond index. And right now that's at 2.85%, up to 3.5%. Right now you're at 4%. Every 50 basis points that you don't get in yield or lose in yield is worth 10% of your liability. So that's $40 million for every 0.5% you don't get an expected investment return.
So if we were to implement something to encourage retirees to be on a Medicare supplement, be it free or part of a group, Blue Cross group, that could bring our $9 million to about what?
Everyone who drops off your plan and gets the free Blue Cross plan saves you $350,000
Per employee?
per person.
This is if they sign up individually.
So
That's the value of the benefit.
we could bring this $9 million down to
No, not the $9 million. That's the active employees base. That would come down based on what type of participation, what percent of your retirees drop off. It's the groups who've done this. It's not so much the ones who are retired. They don't really switch that often. It's you have to get them when they're going to move from pre-65 to post-65. It's your communications. It's your person who understands that how the out-of-pockets work. If you have a $500 deductible, you have 20% out of co-insurance, and you have out-of-pocket of $2,000, and you're paying $80 a month. If you add all those up, what's your real cost here? And it might be $6,000, $7,000, $8,000 if you're sick, versus a Blue Cross individual policy that doesn't cost anything, which has very low co-pays and out-of-pockets. And so if you look at those, and someone in your office can explain to them, or they have some sort of communication materials that's emailed to them when they're going through this process, or have annual meetings for them, the new employees seem to favor this type of benefit. And or if your active plan, since it's with Blue Cross, it will probably get a much better welcome response if it's Blue Cross versus Humana, which is about to be Aetna.
Same thing we have with our high deductible plan, which is $9 a month. You start adding the premium you're paying for the non-high deductible plan plus deductible against the $9 a month and the $2,500 deductible. Cash flow, it makes total sense
Right.
to be on a high deductible because they don't think of the premium as spending money. Paying $9, but here you're paying $230 a month that you may or may not use, even though you use it.
Right.
It's going to take a while to make up that difference from the $9 a month before you even break even.
Right. I understand it. It's communication. And if you can have, budget some money and hire, a firm, my wife, I don't recommend this, but wife's company does that. They develop these communication packages for insurance. Since it's so valuable, and if you can explain the benefits to somebody, because no one understands how this stuff works.
So what has been the impact on financial? What happens if we just don't fund it?
Nothing.
In terms of the future of the group health plan, we're okay until as long as the board's around, or
As long as the school board's around. It's considered a debt.
as long as they can afford to offer the benefits that are being offered?
What's going to happen from the perspective of the rating agencies? Those districts that have OPEB funds set up and that was funding them, especially now the new Gatsby's coming out, the distance between those that are doing nothing and those that are fully funding, and then most people need to be somewhere in between. There's so few that are fully funded, but there's a bunch that don't do anything. But you're going to start seeing those bond ratings drop because they have these huge debt on their books that they're not doing anything.
Right.
And that was a big question when we talked to Wall Street. When we have our annual meetings with Moody's and S&P and Fitch, that is a major part of our discussion. What's our plans with the OPEB? How much money we have in there? How much money do we intend? And Billy and I have always spun it in that we have a plan. We have a trust fund. We're funding the trust fund, and we're trying to increase it every year to get to the annual cost so you stop the bleeding. So if that's $9 million a year, then everybody that worked this year is covered. That new teacher that just started is covered so that when she retires, she has guaranteed health care, not guaranteed by a promise of a board, but guaranteed by money in the bank. And that's a huge plus for the employee that starts this year. It's just planting the seeds and the small trees to grow. You have to start somewhere. So, we propose different things to try to start funding this, and we're about to borrow $78 million to build a high school plus a couple of other schools. Bond rating shift could be millions of dollars in interest over the term of the debt. So I think that's where you're going to see a huge separation. And also, if you're choosing to work for a district, you want a district who has guaranteed health care based on money in the bank, or one that has health care based on a promise.
Yeah. You would be in a much better situation what you're doing than there's a problem in the less populated or growing areas of the state. The parishes that aren't growing are actually shrinking. They have twice as many retirees as they have employees. And that's going to be the problem they're going to face is, like I said, you have 800 people or so who are eligible to retire right now. They're 58 years or older. And they're going to move to so you're going to, instead of having 2,500 retirees, you're going to have 3,200 retirees with 2,700 employees. And then 10 years from that, you're going to have another 1,000 retirees and still 2,700. So that's the problem, because mortality is extending now, and people are living into their 90s, and so you're going to have liability for those on Medicare for a long time. And the prescription drugs are just getting more and more expensive.
Scott, may I ask Scott a question along these lines? Aren't these trusts really to protect both the current retirees and future retirees from the politics of budgets and future cost increases that might force a future school board or a future legislative, the state legislature to change benefits because they're just not affordable?
Yep.
I mean, once this
exactly
money
right.
is in the trust, it can't be used for anything but retiree health care benefits, right?
Right. Any other questions?
I have a question. So can you plot out a course to get us to reduce our liability by 70%? What would be the steps to achieve that?
70% would
That's the
be,
number you used.
I used the liability, 70% of it is the liability for those with Medicare. And that's, you wouldn't have put this, you wouldn't have designed this plan today. You would never have covered, because you would never cover a retiree after Medicare if you designed it today. You would cover them to age 65, and then at age 65 they can go, there's Humana, Blue Cross, Aetna, there's all these plans available for them that don't cost anything. They're free. They sign up and they get great insurance because Medicare pays for everything. And you can go to, I advise you go to Humana.com and see what the cost for a Humana Gold policy is. I think it's either free or $25.
Okay. Favor? Aye. While we're talking about the balance of the fund that you're about to go over, I did prepare a little handout on where we are now and the source of those funds. So you know exactly who paid for the money that's in this $10 million. So as you can see from the fund, currently contributions are about $10.6 million. So we had a contribution in 2010 of $3 million from the insurance fund. In 2011, about $4 million, a little over $4 million from the insurance fund. In 2012, there was a general fund contribution of a little over $2.7 million, and then another $400 in 15 and 16 from the insurance fund. So basically, when you're talking about the source of funds, your premium is a 66-33 split, which the general fund covers. The funds from the general fund is about 66%. The employee pays about 33% of the average premium. So if you look at what the general fund has contributed in terms of premium and direct dollars, the money that is in that fund is 75% general fund and grants, and the employee is contributed about 25% of the initial contribution of $10.6 million. And then the income from the fund is made a little under $850,000 since inception in interest and dividends to come to a total balance currently of a little over 11.4. So just kind of a perspective of how we're moving forward to try to fund this thing. In that, how do you eat an elephant one bite at a time? Well, more people taking a bite eats the elephant quicker. So this is a benefit for the retirees. You're looking at a sharing of costs there of 75-25, with 75% of that coming from the general fund for an employee benefit after you retire that would be secure. And also part of that, I haven't gone and figured out how much of that money is the grants, because, and like I said from the very beginning, if you're a Title I teacher, you started your first year as Title I, you work 30 years as Title I, you end up being the supervisor and you retire. Title I has not contributed $8 to that OPEB retirement liability. You retire, the day you retire, $350,000 of liability pops on the rest of the people. If you didn't have Title I, that person would never be there. That $350,000 liability times every Title I employee employee, every grant employee that we hire is all contributing to the liability, but those grants don't pay any of it. Unless you charge it through the premium process, they will pay that, but it has to be consistent across the board. So, part of the plan to fund this is a combination of grants, general fund, and the employee all pitching in, and over time, getting to that 9 million, which we can bring down, hopefully, by encouraging retirees to go onto the Medicare supplements and bring our liability down. So it's a scary number, but it's not something that's like not attainable through over time. And with a goal of having a secured amount of money in the bank for you when you retire, for the promise of health insurance being funded. So I just wanted to share that. I kind of threw that together based on some information that had been erroneous information that had been sent out.
Okay. Anything else?
Presentation of investment portfolio review.
Hello, I'm John Huffman. I'm with Reliant Investment Management, and this is my associate Hugh Walmsley. I'm going to step up here if I can so I can control the board. The slides I have on the board will match the slides in the book. So, I think there's a mic up here. Here it is, right here.
Oh, okay.
So put that other one on the stand.
There's two of them here. I think I'm going to use this one if it's okay. That way I can move around. Otherwise, my voice will fade. My voice will fade in and out. I'm going to run through this review with y'all, and I'll take questions as we go, and I'll also take questions afterwards. So if y'all have any questions, just feel free to interrupt me. One of the things we like to do every year is just look at what might be done with these funds if you did not have a firm like ours managing them. And typically, what we've been told to do is that if y'all were trying to do it in-house, it would be done ultra conservatively. So we've looked at LAMP, which is basically a money market fund, and we've looked at short treasuries, and then we look at what the yield on the portfolio is today. So by using a firm, you are earning more than you would be if you were just trying to do something without the expertise of outside people like ourselves. Last year, the portfolio earned 2.94%. Since inception, it's earned an average annual return of 1.62%. We compared that against several benchmarks. The most appropriate one would be the bottom benchmark, the Citicorp 1 to 3 Government Corporate Index. The portfolio has performed relatively well versus that index. One of the things that Matt mentioned to you is that the higher return, the less your liability becomes over time. Y'all's investment guidelines are very much in line with other OPEB trusts in the state, but at the moment, at least the ones that we manage 5 OPEB trusts in Louisiana, they're all very, very conservative. According to state law, the trust could have up to 55% equities in the portfolio, which would be in line with the statewide pension and retiree benefit plans. When these trusts were first created, there was some ambiguity as to whether equities were actually allowed because of a convoluted process involving a constitutional amendment and some other issues. Am I holding this adequately? We, at the direction of and request of y'all, went to the AG. You all actually passed a resolution. It was passed in conjunction with all the other OPEBs that we're aware of in the state. And the AG gave a favorable ruling that said that he believed you all were fully within your rights to follow state law as it was passed and used all the investment options that are available. Since then, that decision has not been made yet, There are consequences and trade-offs to that decision, and that stocks are much more volatile than fixed income. I want to show you the next slide. This is a slide that we just started including in our presentation about a year ago, because the earnings on a fixed income portfolio, as conservative as they are still influenced by changes in interest rates. If you look down the left-hand column, not the date column, but the next column, interest earnings before mark to market, you will see that the interest earnings have been very consistent and growing over time. Mark to market is something that Gatsby also requires us to do. In addition to calculating your liability to your retirees, at least annually, any investment portfolio has to be marked to reflect what the portfolio would be worth if you had to sell it on that day. And so as interest rates change, with stocks, that's real obvious. Stocks go up and down every day. And there's you can look in the Wall Street Journal and see what the stock closed at yesterday. With bonds, they're a little different than that. Bonds don't fluctuate as much because of the way people are feeling about them. They fluctuate more because of what interest rates are doing. And if interest rates go up, the value of the bonds you hold in a portfolio go down a little bit. If interest rates go down, the value of the bonds will go up some. The magnitude of that shift is directly related to the length of time that those bonds take to mature, what we call an average maturity or average duration. If you look back on this middle column, you'll see that in 11, there was a positive mark-to-market adjustment. In 12, there was a positive adjustment. In 13, there was a negative adjustment. 14, it was positive. 15, it was negative. Last year, it was positive. It was a cumulative net positive adjustment. That adjustment is a contingent adjustment. That adjustment's factored in there so that people don't buy real long maturity bonds trying to get extra yield and ignore what happens in the market, where if you had to sell them for some reason, there'd be a bloodbath. So you all's guidelines, your investment guidelines, and we recommended this, and there's not been any change in this, say the longest bond that can be bought in this portfolio is a 12-year bond, and the longest average maturity across the whole portfolio is 8 years. So you can have some longer than 8 years, out to 12, but you have to have some lower than 8 years. Right now, we're shorter than that. Oh, I'm sorry, this is a contribution history and similar to what Matt just gave you. This doesn't break out whether it came from the insurance fund or the general fund, but it does show the deposits and then the net revenue of the portfolio and what the portfolio balance was as of June 30th. We're using June 30th for everything because that was the end of your fiscal year. The next graph on page, I believe it's 5. Yes, page 5 shows the securities that are in the portfolio have different interest rates that they pay. A lot of that's based on when they were purchased. So if you'll see that the portfolio has 16% roughly that are 1 to 2%, 43% that are 2 to 3%, 25% that are 3 to 4, and about 14 that are 4 to 5%. Those coupons have been coming down over time because interest rates have been low for a long time. But you have a nice distribution there. Right now, the investments, page 6, on page 6 shows how the investments are allocated. Since we're not using any stocks because they're not permitted by the investment guidelines at this point, we've been using a pretty large percentage of corporate bonds in an attempt to earn a little bit higher return for the portfolio rather than just using straight agency and treasury. In fact, we're using about 69% corporate bonds, about 24% agency. Where it says reserves, and this is on page 6, the reserves are simply where we had a maturity or something right before the end of the fiscal year and it hadn't been reinvested yet. Sometimes we'll wait a week or two if we think interest rates are moving or there's some announcements that might influence them. We don't necessarily just plow it back in the next day when we have a maturity. The average rating on the portfolio is in the A range. It's an A minus. We have roughly 42% that are in the triple B range, 24% in the A range, and 33% in the double A range. This is an important chart for the Board of Trustees because your investment guidelines require the average quality to be in the A range. So if it was below A minus, we would be in violation of the investment guidelines. One of the things that makes it tough a little bit is that, and this is using S&P's credit ratings, several years back S&P downgraded the United States government from AAA to AA. And all the agencies are now AA also. It used to be a lot easier to use a higher percentage of triple Bs, which are investment grade, and earn a little bit more income, but when they downgraded the federal government and all the agencies to AA, it made the average drop, and we have to use a higher percentage of single A's and double A's. The maturity distribution, this is real important. If you'll notice that the average maturity, this is on page 8, is 3.52 years. We have the authority to go out to 8 years on average maturity. We are not out at 8 years because interest rates that are still pretty much near historic lows. When you own bonds and rates start climbing, and candidly, we've thought they would start climbing for several years now. We've been surprised, as most people in the industry have been, that they have stayed as low for as long as they have. When they start climbing, it has a temporary but adverse impact on the value of the securities in the portfolio. That's that mark-to-market we were talking about a minute ago. So right now you have a nice distribution. You've got 15% that are less than 1 year. You've got 23% that are 1 to 3 years. You've got 36 that are 3 to 5, 22 that are 5 to 7, and just a couple that are over 7 years. The advantage of this is we're trying to balance maturity with interest rate risk. Since we have a lot of securities that are under 3 years, when rates start to climb, we'll be able to reinvest those securities in higher yielding bonds as they're issued and as rates climb. So that's one reason it's structured the way it is. Again, this is a key point for the trustees because it shows that none of the securities are over 12 years and that the average is under 8. So this is a way to confirm compliance with investment guidelines. We have sector diversification. This shows all the bonds in the portfolio, 22% agency, 3% treasury, 7% reserves, and the rest in corporate bonds. On page 10, it breaks out the government and agency bonds, showing that we have diversification among issuers. There is a fairly strong, I should say, a favoritism towards the federal home loan banks right now. Agencies are all considered to be comparable from a security standpoint. There's some reasons why we have a little bit higher federal home loan banks right now. It has to do with the structure of the call options that they use versus some of the Federal Farm Credit and the Fannie Mae. We try to stay diversified, though, and have it spread among the different agencies. So that's on page 10. On page 12, we look at the industry diversification. There is a requirement in your guidelines that no one company, we cannot buy more debt of any one company if it's above 10% of the portfolio. And if it goes above 15%, we have to reduce our exposure to that company. This chart shows you that even industries, there's only one industry that's above 10%, and that's the banks. And I have a portfolio appraisal at the end of your booklet that will allow you to go through and look at the holdings, individual holdings, and you'll see that no one holding is above 5%, so the portfolio is well in compliance with the guidelines, plus it's well diversified among industries. And then the last part of the brochure is the portfolio itself. Anyone has any questions about any of the holdings? We actually had an interesting question at a review we were doing just the other day for one of the other school boards. Someone noticed that there was a sliver in the entertainment industry, and they wanted to know what that was. And it was CBS. And I'm not sure if you all own CBS or not, but because not every portfolio looks exactly the same. But you can look down through the names of the issuers whose debt are held in the portfolio, and they're names that everyone will know: Johnson Controls, Harley Davidson, GE, ConAgra, Kellogg, Dr. Pepper, Oracle, Moody's, Eastman Chemical, Goldman Sachs, all name brand companies. Everyone's going to, I don't think there's any in there that people aren't going to know. There may be a couple that wouldn't be familiar to everybody, but.
What's Walgreens Boots?
I'm sorry?
Walgreens Boots. Boots Alliance.
Where do you see that?
Page
Oh.
3, second way down.
I'm assuming that's Walgreens Drugs. I'm not sure what the Boots Alliance is. I'll have to
It
check that
is.
out for
There
you.
used to be a Boots Pharmaceutical,
It's Walgreens.
and they, as a result of merger.
Their technical name.
That may be their technical name.
Yeah.
I just never saw any boots at Walgreens, so I don't know.
Yeah, they were in English.
You hadn't seen the white shrimper boots there? So,
And that's all debt of these.
that's all debt. They're bonds. They're investment grade bonds. And at the time when the investment guidelines were created, and I'm going to come on back down there because at this point, there's no point in my standing up here.
So John, you had mentioned that we have the ability to go into equities.
You do, and I will try and make sure I speak loud enough without the microphone so everyone can hear me. According to state law, the portfolio can have up to 55% equities in it, stocks, U.S. stocks. It can also have mutual funds. We have a client, another school board, who approached us last winter about putting stocks in their portfolio. It's an interesting situation because their board, their trust board, is actually the school board. It's the only one I've seen done like that, but that's how they chose to do it. And since each school created their own trust, each school system had the opportunity to create the board however they wanted to. The superintendent very much wants them to be in stocks. He's very familiar with like teachers' retirement, school employees' retirement. If you look at the OPEB trust is very similar. In concept, it's identical to those retirement plans. It's
Same
designed.
beneficiaries, too.
Do what?
Same beneficiaries.
Right, same beneficiaries. The trust is there to provide benefits to retirees. And in this case, it's not pension benefits, it's non-pension benefits, it's healthcare benefits. Has the same lifespan, has the same long-term perspective. It should go on for perpetuity as long as the government doesn't get merged or dissolved or for some reason go out of business, which doesn't happen very often. Stocks are more volatile, and there's been a lot of concern about the public perception of volatility in the portfolios of the trust. People don't seem to be as concerned about the volatility in the pension trust. And we all saw them get hammered in 2008. They've come back. The average return historically for a balanced portfolio, typically a balanced portfolio is considered to be anywhere from 40-60 to 60-40. A common balanced portfolio is 60% stocks, 40% bonds. So the state law letting you all go to 55 would be right in line with that. A very simple way to get exposure to the equity markets, and we recommended this to this other client that asked us about it, and they have not chosen to pursue it yet, was rather than getting fancy, and we manage stock portfolios also, we manage balanced portfolios. But rather than getting fancy and worrying about, manager style, do you want growth stocks or value stocks, do you want large cap or small cap, would you be to amend the investment guidelines to allow an allocation to equity index funds, something common and broad-based, the S&P 500 or something comparable to that. Costs are low. For doing something like that, our fees would not change. If we started using individual securities, which down the road might be a very wise thing to do, our fees would have to change because there's a lot more work in managing stock portfolios than there are bond portfolios. But we could come in with an index strategy, even if you wanted to go 10% or 20% of the portfolio, and see the volatility, see how the market's impacted. That's one reason I showed that mark-to-market impact, because even bonds are not immune to the marketplace. Some years the market helps them, some years it hurts them. What's really earned in bonds year to year is pretty consistent if you ignore the mark-to-market. which you cannot do under accounting principles. But I think it's important to see that even with fixed income, there is volatility. And most people don't think about that because almost no one, I don't know who has individual savings, none of us mark our portfolios to market. Now, if your securities are kept at a brokerage house, they may do that for you. But most people don't take that into account. But as a governmental entity, just like a corporate entity would have to, mark to market is very important. It prevents abuses. So that's something to think about because when rates start moving back to normal rates, which I would say normal rates would be where the 10-year treasuries in the 4 to 5% range, and we're a long way from that now. We're going to have several years where on a mark-to-market basis, the portfolio is going to look really bad because the securities will be marked down every time there's a rate increase. Now get it back. If, for example, a 2-year security gets it all back in 2 years because it matures at par. A 1-year really doesn't get marked very badly because it only has a year left to go. It gets marked a little bit. A 5-year gets it back over the 5 years. And you will be earning more because as we have those maturities, we can reinvest them in those higher rates. But you know, when rates start climbing, I don't know when it'll be. If I did, I'd be a billionaire. But when they do, I know they have to go back to normal at some point. It'll hurt. Now, if there's equities in there, historically, and there are exceptions to this, equities have done better when bonds have done worse, and vice versa. So, a mix of equities and bonds has historically tended to be more stable than either all bonds or all equities. Now, again, there are exceptions to that. I mean, I could go and find them for you and show you where the exceptions were. But it would be prudent, in my opinion, and this board would have to make the decision to amend the investment guidelines. And we could certainly work with y'all to make some recommendations for y'all to consider. But it would be prudent, long-term, to have equities in the portfolio. Now, it would give it more year-to-year volatility and month-to-month volatility. We just have to be aware of that. And I'm a former elected official. I was mayor of the town I live in for 8 years. And I know the problem with public monies is that everyone and their cousin is looking over your shoulder about how it's managed and how prudent it is. But I think Scott made a reference earlier that every 50 basis points in higher return either raises or lowers your liability by, what was it, 10%?
$40 million.
$40 million. So that's roughly 10%. Right now, they're using a 4% assumed rate of return. Long term, that's actually even conservative for bonds. But right now, for the last 5-8 years, it has not been. A long-term average rate of return for a balanced portfolio probably be very comfortable in the 6% range. Theoretically, it could be in the 7 long-term. Again, a lot depends. If we weren't at historic low interest rates, we wouldn't be at 3.5-year average maturity. We'd be closer to a 5 to 7 year. Maybe even bump into 8 year. As in a normal interest rate environment, you do gain a higher return from having longer maturities, and in a normal interest rate environment, the risk of rates going up is balanced by the risk of rates going down. Right now, with rates so low, there's just, unless they go negative, and they have gone negative in Europe and Japan and Switzerland, but they're not paying negative rates, they're just charging you to hold your money. So they're not paying you to borrow, they're charging you to invest with them. Some countries are going to pay $101 for a 10-year bond that at the end of 10 years you only get $100 back and no interest in between. That's remarkable to me. But, so I don't know if there's any questions on.
So I guess the board just has to kind of the right stocks in the portfolio, and if we did, what percentage would be comfortable with. I think you're right in the balanced approach that, you know, we're all in bonds, you still have a mark to market.
Right.
And a loss isn't a loss until you sell it.
That's right. So mark to market's a contingent loss. And with the stock now, a stock can go to zero. And you don't even have to even sell it. So that's now there is more risk in stocks, but as we've all been taught since we were a little bitty child, you know, there is no free lunch in the long term. And so You can take a lower yielding security with less risk, or you can take a higher yielding security with more risk. Historically, entities that could withstand the volatility, that could stand the risk, have had higher rates of return. I mean, there's a really good reason why teachers' retirement is not being invested all in bonds with a very short duration. It raises the cost of funding it over time. But, this board, and I would say it would be important to educate the bigger board, the school board, is that, if you're going to add equities, they just need to realize that's because over the long term, and I'm not talking 3 years or 5 years. I mean, there's times when you have 3 years or 5 years where things are rough. But over the long term, the return cumulatively compounded should be better. Can't promise it will be, but historically it always has been. There are very few, if any, 10-year periods where it has not been advantageous to be in a balanced portfolio.
So if we were to go with an index, you would use an index mutual fund?
That's what
Rather than buy individual stocks?
That would be the simplest way to start, and here's why. There's several thousand firms like ours around the country. We have a pretty good record on stocks. We have a really good record on bonds. We're completely capable of adding stocks to your portfolio using individual names. Long term, that's probably what I would recommend. But since y'all have not, the school board, to my knowledge, never owned a stock, because unless it's donated to you and you sell it to go into, it's just not permissible outside of this trust and the retirement funds that you all participate in. My first thought would be to, like I said, not worry about manager style, not worry about manager bias, not worry about are we the best manager or are we not the best manager. If you start with some indexing, you're getting exposure to the market on a market level.
Would the indexing be cheaper? I mean,
Oh, yeah.
At this from a standpoint of the 403Bs, where you have an indexing fund, which is basically you're not paying the manager, just writing the index. And
Well,
buying
and here's, you're right, here's where the balance would be. If you were not indexing and you were buying mutual funds charge fees, just like our firm charges fees. Our perspective is, whether it's us or another firm, if you have enough assets, it's generally better to have someone own individual securities for you than own a mutual fund. The fees end up being about a wash typically. But if you take an index approach, the index fees are considerably lower than actively managed funds or active managers. I would probably be looking at a Vanguard or a Fidelity type index fund, something very low cost. And we do that for some of our smaller clients already. Right now, we're charging you all a very competitive fixed income management fee. We could do the indexing and not change that fee. If we were doing a 45% equity bond portfolio, our fee wouldn't double, but it would need to go up because there's a great deal more work in managing equity portfolios or balanced portfolios than managing fixed income portfolios. But we could do the indexing without having to change our fee, if that makes sense. Because we're not having to research and pick individual names. We're picking probably one, maybe two index. Probably start off with one, just a broad-based index fund, and something that conform with state law and would conform with the changes you all make to your investment guidelines.
Think about it. I guess 10% popped in my head just as put the foot in the water and give us a little bit better rate of return, but
10% is not going to move the needle a whole lot. It would be a very safe way to dip the toe in the water. I would probably say go 20 or 25%. Again, it doesn't make it, my fee's not changing, so it doesn't make any difference to me from which one you go with. But if you want to do it just to see the volatility and see whether the board has the stomach for the volatility, and both this board and the bigger board, 10% would be a way to do it. But it's not going to move the needle on the return meaningfully. If you went to 20 or 25%, it would still be very conservative, but it could move the needle a little bit. It could add a percent, depending on the year. And even if you had a down year, it wouldn't move it horrifically. I wouldn't, unless we had a 2008 year. But if we have a 2008 year, everything gets beat up. So, except bonds, they did well that year because rates dropped.
Investment guidelines in our board policy, or is it in our?
It's in your OPEB. When the board adopted the OPEB trust, the OPEB trust has certain restrictions in the trust itself. But then within the trust, it designates that this board will adopt both an investment policy and investment guidelines. And I would have to go back and check. I know your investment guidelines don't permit equities right now.
They don't, it doesn't.
The guidelines don't.
No.
I'd have to check your policy because some of the OPEB boards actually wrote into their policy that they would not do stocks. And so it might, but either way, if it was, I would recommend that the OPEB board endorse whatever the change was. If it's in the guidelines, it may be delegated to Billy and Matt, or I'd have to go back and check that. I probably should have reviewed that before I came in today, but I wasn't thinking about y'all asking that question. But I can work with Matt and give you all, if you decide you want to go forward with it, I can give you all the recommended language for you all to approve to change either or both the policy and the guidelines to make it happen.
So we're likely not scheduled to meet again?
We can schedule it whenever we want to meet. We meet once a year, just we pull John in and we
Right.
pull in I want to pull our actuary in just to kind of talk about the calculation and some feedback as he did, and the change in the gas, which is what I want to highlight. What percentage? I mean, I said 10. What percentage?
I heard 20 was maybe some skin in the game.
You would have again, the more you do, the more risk you're taking.
Well, but I think just to get our feet wet, might be a good idea just to see if the needle moves.
Right.
And does it move in the right direction?
And again, you have to look at, if you're gonna do it, I would recommend you make at least a 5-year commitment to it, because we could easily have a down year next year and we'll look horrible. And the biggest mistake that we see clients make, well, they buy high and they sell low. We have one couple that are dear friends of ours. We go to church with them, and we finally told them that we would not buy any more stocks for them because they would come to us. They had a balanced account, and the market would get iffy, and they'd come and say, we've got to sell our stocks. We just can't sleep. And it would always be at the wrong time. It would be near the low. And then a year or two later, they'd come back and say, well, we don't have any stocks. We've got to have some. And we'd say, it'd be at the high. So they were almost perfect contrarian indicators. I mean, I love them that if they go to church with us, we finally sat them down and said, no stocks for you.
So why don't you look at our regulations and see if there are any issues there?
Yes, sir.
And maybe in a month or 6 weeks, we reconvene a meeting, and then maybe we talk about.
And Matt, I'm a blindside you with something, and I apologize in advance. I think I may have mentioned this to you, but I don't remember. All of our OPEB clients use the same custodian, and they've done a great job for all of our clients. They've been very economical fee-wise. They've had good service. Bank in New York Mellon. They've had some pretty significant people turnover in the division that we work with over there. And we're a little concerned that the service levels may be dropping. And there's 2 or 3 other custodians that we also have clients with, other governmental clients with. And I don't know if you all would be open to my maybe presenting an option of a couple of them for you all to consider. I'm not saying you have to, there's no urgency here. Bank of New York Mellon is doing a fine job. They will continue to do a fine job for most of their clients. You all were being handled by I guess it was a subsidiary in the Jacksonville, Florida area that dealt with pools of money the size of this trust. A lot of the Bank of New York Mellon doesn't want to talk to anyone that doesn't have $100 million or $500 million. But this group in Jackson was outstanding. They had very aggressive fees. They had low minimums. They were very responsive. I had the head of the division's cell phone number. I could call him anytime I wanted to. And he and his top members of his team have left, and like I said, they're working hard to keep things on an even keel, but we're just seeing that it might make sense to look at another custodian. There's at least one that we have existing clients with that are identical on the fees, actually have a lower minimum that wouldn't apply to y'all. We've got a 15 or 20-year record working with them. Again, they're independent, so we don't have a dog in this fight other than the fact that, you know, are there settlement issues when trades are done? Or, you know, do they make mistakes on the reports? Do they have to reissue occasionally? Things like that.
And of all the custodians I've dealt with, I've only had problems with Bank of New York. Haven't had problems. We use Argent for everything else. We try. I don't believe we have anything with Bank of New York now. And just in terms of custodian, just for general knowledge, so when we send money, we don't send money to John.
We don't ever touch y'all's money.
Bank, and the bank makes sure John buys real securities, so we don't have a Madoff situation.
Right.
So we send the money to the bank. The bank's job is to verify that the securities are bought before they release the money to John.
There's something called DVP, delivery versus payment. So when we buy a security, we work with an institutional broker and we work with the custodian. And we send, once we've made a purchase or sale with an institutional broker, there's electronic correspondence that goes back and forth, and then there's also correspondence between us and the custodian. Then the broker deals directly with the custodian to deliver the securities into the portfolio, and only when they've received them and made sure they match what we told them to be looking for, do they release the funds to the broker. And if there's any issue, down to a penny, they'll do what they call DK, which is funny, it stands for don't know. And they'll don't know it means we don't know what you're sending us because it doesn't match exactly. And they'll DK it, and then the phones start buzzing and emails start flying, and usually it's accrued interest or some odd little thing. But it's a great check and balance. And that's the only way we work with our clients. We don't.
Bank of New York provides that service at this
Right.
point. You're saying that somebody else will.
So and I apologize. I didn't mean to. So
I'm no fan of Bank of New York.
I remember when I first suggested them to you, you weren't wild about it. But there are some very limited advantages. I mean, nothing significant to us. With all the OPEB trust at one custodian, a lot of times we'll go off and buy $1 million or $3 million block of bonds and allocate it out. And we can allocate it across different custodians. It's slightly cleaner if we allocate it to one custodian. It's less chance for anyone to get confused. But we use multiple custodians all the time, so it's not a big deal to us. We're largely custodian agnostic. About the only thing I'm agnostic about.
Great, so I guess, look into the proposal of going 20% stocks based in an index fund, and because the changing of the from Bank of New York, that's not in the.
Basically, I don't think it would require board action. I'll check and see.
Yeah.
But if you're going to look at maybe meeting again to talk about the equities, if it needs board action, we could have it on the same agenda.
That'd be good.
No other business.
Receive this.
Okay.
I move we receive John's report.
All in favor? Aye. Okay. Thank you. Fascinating.
For any questions?
Move-
No,
move-
German, just.
Oh, okay.
Yeah.
Okay.
Done.
Thanks.
Oh, let me show you this good website I was just talking about.
Okay, hang on, I'm making a little, I'll take a minute.
Okay.
Do you have any questions?